Hi, this is Pete Karabas, and you're listening to the Matt Balaker podcast.
Hello, fine people out there. Thank you once again for tuning into the Matt Balaker podcast. Please encourage your friends to like, subscribe, and share. Today's guest was raised in Chicago, educated in Wisconsin, and now resides in Colorado. He has more than a handsome face, folks. He helped deploy over $700 million in real estate investments and now serves as a founding partner at Key Investment Partners. Please welcome Pete Karabas to the show. How you doing, Pete?
Good, Matt. How you doing? Thanks for having me on.
I'm excited to have you on because I realize, Chicago, Wisconsin, Denver. Like, if you had to pick like a favorite food item from each of those places, what would it be?
Oh man, that's a great question. I've definitely grown up with great food around me. Chicago, got to go with Lou Malnati's Pizza, perhaps Portillo's. If you're not watching the LBs, I suppose. Wisconsin, oh man, everything's great there. Burger, pub food, burgers, the cheese on everything for sure. And then Denver was interesting. When I moved out to Denver, it was still, I don't want to say up and coming, but still on the upward trajectory of like, okay, it's kind of this mountain town 20 years ago, so to speak. And now it's just built out and built out and built out. And so what's happened there is you've just seen a lot of different really good restaurants pop up. And I was there for about 4 years, and it was like every couple months or so, new chefs. You have like randomly you have great Thai food, great sushi. You definitely have some, the green chili is like the Denver thing.
Oh yeah.
Definitely great Mexican food all over the map there. So Denver's a really good mix. It's kind of like the people, the food scene. It's a good mix of people, all different coasts, a lot of young people, a lot of chefs, starting up restaurants. So great food scene in all three of those cities. No question.
You can't go wrong. And I don't think I've ever had a Wisconsin fried cheese curd. What are they like?
Yeah. They're fantastic. So think of like everything you like about cheese. Now you have a really good piece of cheese kind of squished in a little ball. And you fry it up and it's almost got a little air inside it. And then you dip it in different sauces and all that. I mean, you can't really miss with those. Even the bad ones are good,
No.
but the really good ones, like you go to an upscale pub in Madison, you find, a $15 plate of fried cheese curds, you're going to enjoy yourself.
Oh yeah,
And
it's worth the cholesterol spike for sure. And
yeah,
were you a Badger?
that's right.
So I've heard the notorious stories about the fifth quarter at football games. What did you experience those?
Oh yeah. I mean, Madison absolutely is. I would say it's the best, one of the best, at very least, at college football towns out there. And basketball too is great. Hockey's great, but there's nothing like a Super Saturday in Wisconsin. Langdon Street's nuts. The stadium's obviously nuts. We're always, I always say, when I was in, when I was in Madison for 4 years, we went to three Rose Bowls and unfortunately lost all three. So I say Wisconsin football's like always, in top 10, but we can never seem to take that final step and be a national champion.
Well, I'm definitely older than you then because I remember I was a Bruin and Ron Dane, I think, ran for like 5,000 yards in the Rose Bowl against UCLA in the early 2000s. Maybe it was 99, but it just destroyed us. And so that was a good day for Wisconsin football. But thank you for bringing up old wounds. I appreciate that, Pete. I finally turned the page. No, but I want to learn a little bit more about when you kind of realized you had this desire or penchant for investing. Like, when did that begin?
Yeah, for sure. I think going to school, starting business school at Wisconsin, kind of my sophomore year, one thing that's promoted in the business school that I'd say at least when I was there, not a ton of schools have a program like this, but like a very, very robust and highly ranked real estate and urban land economics program there. So I started, I took an introductory course. I was always interested in real estate, even from all the investment landscape, especially compared to what I do now. Real estate's really it's an easy thing to conceptualize when you're young and starting to learn about investing. Someone has a building, they pay you rent, expenses, you keep what's left over. So for me, I was never the 4.0 student or anything like that, but I went and I really was interested in my first real estate course, 306. And it really just went one thing after another when I said, wow, this is interesting. Wow, you can really scale this up. Wow, commercial real estate looks like this. Look at all the different sectors. And I always liked the stock market and bonds and finance. And I was a finance and a real estate major. But ultimately, after kind of taking those in tandem, I kind of said to myself, there's a lot to do in the real estate world that I've recently learned about. I think buying and selling commercial real estate and trying to make a profit that way and spending my career doing that could be very interesting. Real estate markets are all local.
Mm-hmm.
They have all these macro headlines these days. I mean, there are some secondary and tertiary cities right now where the real estate market is booming for whatever reason, where, you go to San Francisco, you're seeing, housing prices, drop significantly, Arizona, overheated markets.
Mm-hmm.
So it's very dynamic. Real estate's very local. And I just took a interest in that and started following it. And then ultimately, after doing enough real estate in my first job, ended up continuing in my second job, but then ultimately that led to me saying, okay, I'm going to step a little bit outside of real estate and kind of crawl up the risk spectrum, if you want.
Crawl up the risk spectrum. That sounds enticing. So before you started at Key, what was your first quote unquote real job post college, Pete?
Yeah, so once I graduated, I went and worked for a company that did they were an owner operator of senior living communities, which is a really fast growing and interesting way to invest in real estate.
Mm-hmm.
All different types of subsectors of that within the senior living space. So you could just think about it as level of care. People who need help with daily tasks
Mm-hmm.
is one level. Some people are just more senior retirement home where, it's like senior apartments, right? It's like
right.
a dormitory, not a dormitory, but
it kind of is. They have keg stands and frat parties and
social events, stuff like that. It's almost like a country club feel. So anyway, senior living, and it's very operational. When you have office tenants, you have 15, 20, 30 businesses. They sign 10-year leases. You take out the trash. I'm oversimplifying it, but it's not complicated. Seniors housing, it's you're half running a hospital in some instances. So that was very operationally intensive. I did that for about I want to say a year. I want to say about a year, and ended up getting a job offer from Equity Residential, Sam Zell's REIT, and then moved over to work at EQR. Did a lot of, and EQR at the time was very different. It had, I shouldn't say very different. It was different from a lot of other REITs. Zell philosophy, if you're familiar with them, they were in 5 big markets on coasts, water, limited supply, Class A rental product. Average occupancy of the whole portfolio, right, is 96, 97%. So fully occupied buildings in the best cities in America where it's the hardest to build, et cetera. So I spent a lot of time focusing on that one product type, mm-hmm. 5 markets, and a lot of that was actually on the West Coast. And re-underwriting every multifamily opportunity that came online, right? Whether we were going to buy it or not, the market intel, just understanding that, and really keeping at EQR, we had a very, very robust set of data and information and comparables, and we owned and operated buildings in cities, and we were almost the hyper expert in 5 cities, as opposed to other REITs where, there's all different types of real estate they own, all different markets. Sometimes the strategies are a little shaky, I'll say that, but EQR really, I'd say, was the foundation of my career as an investor. I'd say that.
So you kind of cut your teeth at EQR, and then you end up working at Partners Group. How'd you land that opportunity?
Yeah, that Partners Group was interesting. So I was in Chicago, 3-4 years of underwriting Class A multifamily in 2-3 big cities. I kind of had my fill of that. Wanted to, frankly, I loved EQR, I'll say that. I learned so much there. But at one point I said, okay, what do I want to do like the next 5 years of my life? Always have been interested on the private markets and private equity, which is quite different than working for a REIT. You're doing similar transactions a lot of the time, but in the funds business, it's a different strategy. You have to always, EQR, for example, they're publicly traded, pass 90% of their earnings through investors. EQR could say, we don't like how the market looks right now. We're just going to wait a couple of years. In the funds business, you always have to go find new opportunities. You have to, regardless of the macro environment, what's going on, you're always in a state of deploying capital. Time is working against you. Preferred returns are accruing. So I would say that you have to get a little more creative, understand different parts of kind of the real estate investment value chain, when to focus on other, certain parts of that chain versus the others, and how to kind of create value oftentimes where it may not be as obvious. So moving over to PG was very exciting. I moved out to Denver, very culturally different. I mean, I'm born and raised Midwesterner.
How so?
Yeah, so I'm a born and raised Midwesterner. Obviously went to Wisconsin, and worked for a Chicago firm where out of school, right, a well-known one, buying real estate, and a lot of the guys I reported to were Chicago guys, my buddies and dads age, right? So it's just very familiar. Partners Group is based in Switzerland, in Zug, small town outside of Zurich, but very low tax rate. And so they had put their North America's headquarters, they were moving to Denver. So when I got to PG, I went from like everything I knew, which is Chicago, Midwest, real estate, blah, 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 to all of a sudden doing real estate deals of all different types all over the U.S., and working in a very Swiss culture, with people from all over the world, right? From, Italy, Australia, Switzerland, France, just everywhere, right? It's a global private equity firm. So it was quite different. And I'd say everything I said about the funds business earlier, going from a REIT into that culturally different culture, I guess, and moving to a very different business. It's real estate, but very different business. I think the first deal I looked at PG, we were looking at rolling up 12 Hilton hotels. And I just had no idea. You look at hotels so differently than multifamily. You're signing 2-day leases. That's really how you got to think about it, and way different metrics. And then fast forward another 2 months, and then now I'm working on offices with another, on a portfolio where some of the assets are in the U.S., some of the assets are now in Europe, and we're going to buy all of them and get some type of deal. So it just was way different than there's a 40-story building in San Francisco that's brand new, and we think we can get it to 97% occupancy, and let's hold on to it for 10 years. Just a way different way of investing, different goal.
Yeah, so different. You go from 10-year leases, so to speak, to two-night ones, but you didn't stay there. You had this very stable, prestigious job. What happened?
So I love PG. Learned a ton there. Couldn't be doing what I'm doing now if I never went there. So and there's two for that. One is I learned the funds business and the ins and outs of that. And then the other part is, of course, I met my two partners, Tibby and Jordan. And so the way that developed, I would have never guessed. I would have never guessed I was going to be doing what I'm doing now when I started my job at PG. And I think what happened, right? I had moved there in 2015. Okay, so cannabis in Denver and Colorado was still relatively new. It was like, people were landing there to go skiing. It's like, all right, let's go buy legal pot. It was like a new thing. And so
they had to do it in a whisper. They're like, let's buy legal pot. Go ahead.
Yeah, they want to go like smoke it in the parking lot. And that's all the bud tender tells you. You can't smoke it in the parking lot. Right. They still feel like it's illegal. But anyways, it was brand new. It felt still at the time like this out west Denver, California thing. Anyways, 2015, now fast forward, being at PG for about 3.5 years. During that time, just saw the industry growing like wildfire. Now all of a sudden, like you're, working for a big private equity fund and you see, across the hallway, right, you have, and it's a figure of speech, but the same office buildings in the same areas, you have these big cannabis startups coming on. Oh, that's a cannabis software company. What the hell is that? What does a cannabis software company do? Oh, well, they're a POS company, and that's a data analytics company, and this is a customer loyalty company. So you saw all this unfold, and in the background, you're starting to see some states legalize cannabis. Long story short, Tivy and Jordan and I were great friends, worked together every day. We all moved out there, different parts of the nation, not knowing each other. So met there, we're buddies, worked together all the time. And we kind of at one point just started talking. I remember one instance in a hot tub. We were in one of the mountain towns, Vail or Breck. And we were just talking about, different things we could do from an entrepreneurial perspective. And all of a sudden you see, okay, well, the funds business works. It can be lucrative if you get it right. Right. We think we can do it. And who better than us? Three guys in Denver to go out and try to raise money. We were on ground zero in Colorado. After enough research, we said, well, I don't know what we're waiting for. This feels like it almost fell in our lap. And eventually we decided to, we quit our jobs at PG and we left. But it was, let's say this, I often joke our greatest asset was how overconfident we were in our ability. Oh yeah, it'll be 9 months. We'll have $100 million fund. How hard can this be? So many people. And boy, could that not have been further from the truth.
Well, I don't think any new business would start if the entrepreneurs realized what it involved.
That's right. It's like a blessing and a curse.
Ignorance is bliss.
You know what's involved. I'll just say once you get deep enough where you feel like you can't turn back, then you say, "Oh man, well, we really
no return." Yeah. So, what was the reality? You thought it would take 6 months. It took 7 months, and then you got $500 million in, and everything was easy.
Yeah, that's the story. Exactly, man. No, so it took, let's see, let me think about this. It ended up taking us about, 18 to 24 months, so about 1.5 2 years, if I'm doing the math right, till we got to like a first close. And, if you know our business, that's just a big moment because you have deployable capital. And, up to that point, when you think about what really is your firm, what was key at that point until we had one fund product. We were three guys in a pitch deck and a website and some debt, and that's it. So until you close on the capital, you don't feel great. You also had a lot of costs. You got to front a lot, the proper amount of money and startup costs, and that was an incredibly, I'd say, rewarding and relieving moment. We had closed on about $8.5 million for Fund One at the time, which felt not the $500 billion, unfortunately, by a dime, but it it felt like it was 150 after those
Sure.
last 2 years. It was just a mix. I always say I can never decide if it was exciting or relieving, or it's like 50-50, somewhere there. I don't know. Some days it was just relieving. I didn't even know,
Well, it's validating because I mean, you all are smart people, but not necessarily experienced in raising capital. And you mentioned it took, call it, almost 2 years to close this first fund. What kept you going? Because obviously you're going to get a lot of rejections. You're friends, but being friends is different from being business partners. Like, how did you navigate through the tough times?
Oh yeah, for sure. You know, Tibby and Jordan and I worked very well together. I think we have very complementary skill sets. We definitely got at each other's throats here and there, as at the start of our fundraising journey and whatnot. But I'd say what kept us going, I really believe this, is that we really genuinely believed and still do in the upside of the cannabis industry. The more and more you get ingrained into it, I think you start to know that it's not huge, right? People sometimes think this big industry and, it's going to be 30, 40, 50, 100 billion one day. When you're talking about people and relationships, I mean, using round numbers, maybe, 20, 25 funds, maybe there's, 100 portfolio companies everyone kind of knows, and new ones popping up here and there. It's not a crazy huge space, but once you got ingrained in that, seeing people's vision, seeing where the industry was going, and then seeing the real need for capital and how far it could go to develop the industry, and then also the investor interest, in the industry. And that was really our goal with Key is, we left PG and we said, we want to create like a real institutional style, well diversified, well thought out strategy to invest in cannabis. Originally we even thought we're not even going to touch the plant. That changed over time, but that was, if you look at our first portfolio, half of them are, tech non-plant touching or tech deals or whatever. But I think what kept us going along the way was I don't think there was a point in time where we didn't believe in the industry itself and the opportunity. So we always had that carrot that we were looking at, and we got a lot of positive reinforcement. It's just what we underestimated and what took a long time, I would say, is you don't realize how tight the capital markets are, how limited the number of people, all the traditional, you can raise, billions for real estate,
Right.
if you have the right track record, and PG raises, invest billions and billions and billions of dollars in pension funds, endowments, consultants, you name it. There's so much money out there in the private markets. In cannabis, it's just such a small sliver of that, and that was what we underestimated, I would say, and what was really difficult was finding that, whatever it could be, 1 in 30 if you're raising capital for real estate cannabis. It could be 1 in 200 people want to invest, and it's a different ballgame. It really is, still is today.
Yeah, and you said a lot of important things, but I remember when I first met you, Key only invested in like ancillary businesses, and then that kind of progressed to plant touching. What motivated that switch, or I guess expansion?
Yeah, that's right. That's exactly right. We almost had a bit of an identity, at least with our investors and people. We were prospective investors as kind of the cannabis ancillary guys. This is kind of a different angle.
Yeah.
We're not going to go, invest in a dispensary or two in a new state, which 90% of the people, especially 3-4 years ago, you say we're a cannabis fund, the first thing they thought is, oh, you're investing in grow operations and dispensaries. When you told them there were these ancillary companies, it was almost like, wow, this is a whole new world. So it was attractive in that sense. And I'd say what made us fall away from just focusing on ancillary only was pretty simple. It's really just, you saw a lot of people doing well and making a lot of money and a lot of opportunity on the plant touching side. There's just other things, we felt up to that point we really needed to take the time to understand and learn. And a big part of that is just how different investing in plant touching businesses can be state to state. How do you find a brand with real brand equity? There's so many brands. Mm-hmm. Which the brand in California, does that work in Illinois and New York? And this was 3 years ago, right? Even now, this is a hard question, but 3 years ago, it was 4 years ago, that's hard. How do we understand what you need to put together a proper grow operation? How do we understand pricing compression in a market that none of us have much experience in, at least up to that point? So there's just, and then the Section 280E, 4 or 5 years ago, people think there's banking issues now. It's even so different. 4 or 5 years ago, it was like, and we were paranoid that our fund was going to get its bank account shut down, right? And you can't bank with Chase and Wells, any of the big guys, but that's not an issue. There's a lot of banks out there, but it was just a different time. You had plant touching felt for a number of reasons I talked about, but then also, for some obvious ones, just like, oh, it's still federally illegal. We've had investors back in the day ask us, so I like what you're doing and I'm going to commit capital, but I'm not like going to get in any trouble with this, right? No. You did that.
No.
Yeah. Don't worry about that. Before we left PG, we made sure that was the case.
Well, it was a good way for investors to dip their toes in, so to speak, because if you're investing in an analytics company, it's like that's pretty far from a grow, even though it will help a grow operation. Totally.
It's right. And I'll also just say, like, there's a whole camp of people that I think is, tech people, tech investors, people who've done well in the space. And, tech has dominated, venture and private equity in a lot of ways. And from 2000 onwards, right? And so there's a lot of those types of investors who say, you know what, I don't know anything about growing cannabis. My roommate's buddy did that back in college, but I don't know what that looks like in a real scale. But I do know about customer loyalty businesses and SaaS platforms that might help monitor nutrients in plants. If they can scale that up and you do some simple math. So there's a big camp of people who I think like our strategy for that reason too. Just, hey, I don't know cannabis. Nobody does. But I do know tech, and this makes a lot of sense.
Yeah. Well, there's a lot I like about key investment partners, but I think one of my favorites is, you have the three of you guys in your team who are really smart and like kind of traditionally educated. And then you help these groups. And I've gotten to know a lot more of these operators too over the years, where they were the ones, selling pot in high school. And at least when I was there, that was considered like really like dangerous or but yeah. There are these, it shows like the value of quote unquote like college education, but also and maybe even more importantly in many cases, there are these entrepreneurs who are on the ground floor who know like how to treat their customers right. They know how to display product, like all these kind of like very tangible nitty-gritty things. And you at Key are like combining the two, and it's like right. So I guess what have you learned from either looking at deals or entrepreneurs that was not taught to you in college?
Oh gosh, yeah, a lot. Almost everything, I think sometimes. I'll say this, it's cannabis is such an interesting clash of, if you want to, I always crack up sometimes when I see like, this guy's been he's had a 30-year career growing cannabis, and but it's all good, it's that the truth is, someone like that is very valuable. And so sometimes I think there's a tendency, for, the traditional finance guys to say, oh, all right, we need some really corporate, very well put together, very, stereotypical team do this. And the truth is in cannabis, it's a big mix of everything. There's people who've been in the illicit market for years. Okay, now it's legal. There's people who have been in the medical space, whether it's cannabis or other things, but nonetheless, know the FDA, know clinical trials. And so then there's people in tech and advertising and marketing and all the above. So you have all these different sectors that are kind of people from those sectors are jumping in and doing what they used to do, but for cannabis, just like us. I think what I've probably learned the most, and that Tibby and Jordan and I talk about a lot, is just, how important it is to really understand the intricacies of any one of these operating businesses. None of us are operators. We've kind of come from, traditional finance and banking, traditional financial education, and worked our way, so none of us three, right, have went and operated, 3 cultivation facilities and 20 dispensaries and even a smaller operation, a company with 70 people, right? We're more analytical and financially experienced. So I think one thing we learned was to leverage the people around us to really help make sure that we understand fundamentally how these businesses are working, what the real issues are, and what challenges they face, and helping that evaluate our investment decisions.
Nice. And you've seen, more pitches than I can probably count. In your opinion, Pete, what makes a good pitch?
Yeah, it's a good question. So I'd say most importantly, and this is just my personal preference, I think everybody's a bit different, but I think the people that can communicate very quickly how their business functions, how it makes money, what it looks like today, and what it can look like in the future succinctly is very important. And that may sound a bit cliche, but it's just, it's not as much of a time thing. You always have time to look at deals and evaluate deals. But when somebody can explain something really crystal clear and simply, it's just the biggest mark that this makes sense, that they understand it, I understand it, and then going into the detail later. Like sometimes you can have a 2-hour pitch and you get 1/10 of what you would get out of talking to someone for 15 minutes. They say, here's what we do, how we do it, here's kind of where we are today, here's the money we're looking for. And going down that path the right way, I think it is important. And there's just, especially in cannabis, one of the struggles we face is definitely there's so many people raising money, there's so many opportunities, and there's such a wide spectrum. And so just really nailing down what we like, identifying those and saying discipline around that, you just have to pay constant attention to all those things.
Yeah, it's a wide net out there, and I like what you said about brevity. When I was on the buy side, I kind of pared down due diligence to basically 5 questions. The first one was, how do you make money? And the second one was, what are the risks of that not happening, in your opinion? And that would help just simplify it, because like whether it was Bitcoin or, it got into all these industries I just did not understand. And I figure if I can't understand it, every other subsequent step is going to be meaningless because I don't even know what this company's doing. Right. I think you've kind of taken that and enhanced it to a much better level.
Yeah, and it's totally true, Matt. And I'd say one thing I think it's useful to know, even for someone who's raising money from a fund potentially, is just, I always have the hat on is, not only do I not need to understand this, right, and believe that it's a great risk-adjusted opportunity for my investors, but I also have to, once we invest, then I'm explaining it to people for the next 7 years, 10 years. So to think with that lens, and if you talk to someone 2, 3, 4 times and you can't put together exactly how they do it. No, one, it's like the cardinal rule of overcomplicated deals are bad. And 2, if you can't understand it and you're in the business of understanding opportunities, one of your investors you talk to, here and there, it's not going to make sense. And we have to raise money too. We're just a part of the whole chain. So
invest in what you know. Well, you've had quite the arc, but career-wise, Pete, what are you most proud of?
Definitely, I'd say starting key in everything we've been able to accomplish and everything I think we'll accomplish in the future. I think my career, I wouldn't have changed anything about it. EQR was fantastic. It was kind of the foundation partners group, learned the fund business, had a ton of great people, understood a lot of things I didn't previously know existed, and really set me up, and Matt, Tibby, and Jordan set me up to what we're doing now. But far and away, in terms of accomplishments, I think it would certainly be just starting the firm and getting to that first close of Fund One. Felt like I ran 2 back-to-back marathons and just crawled over the finish line. So
you survived. You crawled over the finish line. In terms of the cannabis industry, what are you most optimistic about?
Yeah, that is a good question. I'd say what I'm most optimistic about today is some of the stuff we're seeing in Washington right now. And some people in the industry might kick me for saying that just because we've been let down so many times. But when you really dig into details, I think it's nice that this HHS recommendation to the DEA is not in Congress, so maybe it can move a bit faster. Sure. I think it's lining up nice, and safer would be great too, but of course we'd rather have the rescheduling. And so assuming we can get some regulatory progress after all these years, material regulatory progress, get rid of Section 280E, I think that's just going to light a fire under so many businesses. And, I always say this to investors too, like one thing you learn with the ancillary strategy is all their customers are the plant-touching businesses. So when you think about Section 280E, hundreds of millions of dollars, just if you look at the top 20 publicly traded cannabis companies, but then every other one that's not listed, it's so much money saved. And that money is now, those businesses can spend it on becoming more efficient, on buying software, on being competitive, on hiring people. So those savings are going to be crucial to the health of the industry at large, from the biggest company to the startup with no revenue. So I'm optimistic we're going to see something there here in the next 3-4 months, knock on wood. But it's going to be incredibly exciting for the industry. Biggest catalyst since we started Key back in 2018.
Well, it's nice to hear legitimate optimism, and I kind of share your enthusiasm. Well, thanks, Pete, for joining us. We definitely want to have you back. Where can people learn more about you and what you're up to?
Well, I suppose I have social media and all that. I'm not that active on it, but we're always blogging on LinkedIn, on our newsletter. You can sign up for it on our website. And we're big proponents of sharing all the good progress we can with our companies and our firm, with everybody. So definitely follow us if you can.
Yeah, I subscribe to that newsletter. It's very worthwhile. Pete, thank you so much for joining us. Really appreciate it.
Thanks a lot, Matt. Thanks for having me.
Thank you for listening to this episode of the Matt Balaker podcast. To learn more, please check out mattbalaker.com and encourage your friends to like, subscribe, and share. Really appreciate it.